The Peter Schiff Show.
Well, we had some big action coming out of the central banks. We had the Bank of Canada yesterday lowering interest rates from 1% to 0.75%. And today we had the ECB launching or announcing the future launch of their first QE program. In fact, yesterday they floated a trial balloon that they were going to do $50 billion a month. And the market liked that. The euro sold off, but then today they came out with $60 billion a month. So maybe they leaked that lower number so that they can surprise everybody with an even bigger QE and have an even bigger drop in the euro. And if that was their goal, they succeeded. The euro plunged, biggest drop I've seen in a while. And, that's saying a lot. It was down on about 2% or something like that against the dollar today. As much as the euro was down against the dollar, it was down even more in terms of gold, because gold was up about $10. We closed above 1,300, I think, for the first time since August. But in terms of Canadian dollars and euros, we're above 1,600 Canadian dollars. Also, in terms of Australian dollars, gold is above 1,600. The euro closed just below 1,350, or gold closed just below 1,350 euros. We're up almost 200 euros, 20%, 200 euros an ounce in less than 30 days. I mean, that is an enormous move for the price of gold. I mean, if the goal of QE in Europe was to make gold a lot more expensive for Europeans, they sure have succeeded. But of course, supposedly the real goal of quantitative easing, both in Canada, although Canada's not doing QE, they just lowered interest rates. But the goal of these central banks, whether it's lowering interest rates or doing quantitative easing, the goal is to raise the level of inflation. Right? No, and all of the major newspapers, all the economists are applauding this. They've been, beating the drums for it. Here's a typical Bloomberg article. This is from a couple of days ago. The title of the article is, "The ECB may take a historic step this week to save the Eurozone economy." Save the economy. Save it from what? And if you read the article, it's save it from deflation. Even though they don't even have falling consumer prices, right? They just don't have rapidly rising consumer prices. They have inflation of under 2%, right? And maybe for a few months, it's even sub 1%. I wonder how long that can last, but somehow we've got to save the economy. In fact, that's what the Bank of Canada said. When they reduced their rates, they said that they're doing it because they think inflation might be too low, and that's why they're taking this action. Now, Canadian inflation, as measured by their CPI, was 1.9% last year, and they're worried that it might be, 1%? Well, why would you worry about that? What is wrong with that? I mean, I feel like I'm in a twilight zone here, although I don't even know if Rod Serling could write an episode as bizarre as this, that people can actually believe that it's falling prices, or not even falling, just that prices aren't rising rapidly enough, right? That they're only rising 1%. And oh my God, we have to save the Eurozone. We have to save Canada from the threat that prices won't go up. And we have to make sure that prices rise. Let me read a little bit of this article, because as bad as the title is, the body of the article is even worse. And remember, this isn't even not in here as an opinion piece. This is news, right? This is supposedly news. So here's how the article starts out. It says, the European Central Bank is weighing a proposal to inject as much as 1.1 trillion euros into the Eurozone economy to stave off deflation. Now it defines deflation, a dangerous downward spiral in prices. Who's a dangerous downward spiral? I mean, are prices spiraling downward anywhere? Consumer goods? No, and certainly not in Europe. Prices aren't even falling. They're just not rising that much. Also, what's so crazy, right? The guy is worried that falling consumer prices are going to slow down economic activity. I mean, what about all the taxes and all the regulations and all the mandates? He's not worried that any of that is slowing down economic activity. Look, if the European government is really concerned about economic activity and what may or may not slow it down, the fact that consumer prices might drop somewhat isn't going to slow economic activity. Look, are more people buying cell phones now with the prices low than 20 years ago when they were high? Falling prices accelerates economic activity. The lower the prices, the more people who can afford to buy, the more volume you do. So falling prices encourages economic activity. Rising prices stifles economic activity. But if the Eurozone is worried about economic activity being impeded by something, it's not falling prices. It's their own regulations and taxes that are slowing down the economy, not the fact that people don't have to pay more to buy the things that they need. But then he goes on and says, he starts to write about the situation. He says, the first thing you need to know is that the Eurozone economy is very, very weak, right? According to the statistics, the unemployment rate is 11.5%. Growth in the Eurozone is less than 1%. And recently, the area has been experiencing deflation, a dangerous decline in prices that prompts people to delay making purchases and investments and drive down economic activity. No, it's not. They've had like 1 month, right, in the past year where prices went down. I mean, and they barely went down. They're like down 0.1%. That's experiencing a dangerous decline in prices. I mean, they're barely down. And then he's like saying, because they're down, people are delaying their purchases. No, they're not. There is no evidence to suggest that anyone in Europe is delaying their purchases because prices are down. In fact, if anything, they're delaying their purchases because they can't afford to buy anything. And if prices went down, maybe they could actually buy. The reason they're not buying is because they can't afford it, not because they think the price might go down. Maybe the 11.5% unemployment rate has something to do with why people aren't buying. Maybe they're not buying because they don't have jobs. It's not because they think the price might go down. Again, nobody can even come up with an example of any good that they're not going to buy because they think it might be 1% or 2% cheaper if they wait a year. It's ridiculous. You know, there is a lot of unemployment in Europe, but the way to solve the problem isn't to make prices go up. That's the way to compound the problem. What they need to do in Europe is reform their labor laws, stop punishing employers for hiring people. Let's have some free market in employment. And now people will have jobs. And if they have jobs, they'll be productive and they'll be able to afford to buy stuff. And the lower the prices are, the more they're going to be able to buy. But, you know, when Europe does quantitative easing, it lets the politicians off the hook because they assume that inflation is going to solve their problems. So we don't have to reform the labor laws. We don't have to reform our tax code. We don't have to cut government spending because this magic, this monetary magic is going to do the trick. But this all-out propaganda effort, when you read these articles in Bloomberg, in which they're just stating as fact that Europe is suffering a dangerous downward spiral in prices, when prices are in fact rising, and saying that they know for a fact that because prices are falling, people are delaying their purchases. They are not. Nobody is delaying their purchase. If they're not buying, it's because they don't have the money, because they're unemployed and because they're worried. They're not worried that the price might go down. They're just worried that they can't afford it. And if they can't afford to spend money now, if they can't afford to buy something at the current price, what hope do they have to afford it if they succeed in making the prices go up? If you can't afford to buy something, the only way you're going to buy it is if the price goes down, not if it goes up. If it goes up, then you have no chance. Maybe if the price comes down, you might be able to do it. Or, of course, maybe if you get a job and you earn more money. But none of that's going to happen because those problems are not getting solved because the central bank is doing quantitative easing. Instead, they're compounding those problems. So now not only will the unemployed not have jobs, but whatever money they have, you know, they're going to be able to buy less stuff because the prices are going to go up. The one place that I think both Europe and Canada will succeed is in driving up consumer prices. I have no doubt that they're going to do that. Now, some people might say, well, quantitative easing didn't result in higher prices in America. And I would beg to differ. I think it did result in rising prices. It's just that I think the CPI didn't necessarily capture it all. And a lot of the money did go into financial assets. But I think more importantly, the U.S. dollar as the reserve currency, we were able to export a lot of our inflation to our trading partners, particularly China. And I think there was a lot of inflation there because when the dollar goes down, it doesn't go down against the yuan. But neither Canada nor Europe are in that position. The Canadian dollar is not the reserve currency, neither is the euro. The euro is not pegged to the yuan. So the cost of Chinese imports is rising now for both Canadians and Europeans. And up until, recently, neither Canada nor Europe are running trade deficits. They have surpluses. So they're not exporting their inflation. They're going to have to deal with it. And I also don't know that they're going to get as big a financial boost out of QE, because right now QE is causing a flight out of the euro, for example. Even though the DAX was up today, it was up just over 1%. Right? In terms of U.S. dollars, the DAX was down. In fact, in terms of gold, the DAX got clobbered. Our stock market, the Dow, was up 259 points today. We actually got a bigger boost at a European QE than Europe. And of course, measured in euros, right? If a European looked at the big move up in the Dow was running circles around German stocks or any of the European markets. So I think what could happen as a result of this QE is that more European money ends up in foreign assets. Maybe not even some in the U.S. They might be in the Asian markets. Who knows where that money's going to go? But a lot of it could leak out of Europe. And so I don't think they're going to get as big of a phony boost to their economy. They're not going to get as big a, QE high as we did, because I think more money is going to flee the currencies and those asset markets, and they're not going to be able to export their inflation. So I do believe that before the end of the year, we're going to see official inflation rates well north of 2% in both the Eurozone and now in Canada as well, but particularly in Europe. And the question is, what is the ECB going to do about it? Because if their goal is to lift inflation, and they announced this open-ended, this QE program that can go on for a year and a half, what happens if just after a few months, or maybe even before they started, it hadn't actually started yet? They're just announcing that it's going to start. But what happens if before it starts, the inflation numbers already pick up to the point where we're already at the 2% level? Are they going to go through with it anyway? And what if official inflation measures start to really move through 2%? Then what are they going to do? I think they're really opening up a Pandora's box here. Because remember, even though the goal is higher inflation, that's not really the goal. I mean, that's supposedly the means to an end. The real goal is to stimulate the economy, right? That's what Europe wants to do. That's what Canada wants to do. But they think that they need inflation to accomplish that. They don't understand that if your goal is to stimulate your economy and you succeed in creating inflation, you actually move further away from your goal, because inflation is an obstacle to economic growth, is an impediment. It's not a facilitator. They also want to create jobs. Well, you don't create jobs by increasing the cost of living. You don't create jobs by making things more expensive, right? You don't create wealth by impoverishing your citizens. A growing, healthy economy, when an economy is getting wealthier and more prosperous, prices are going down. That's what you expect, right? You're producing more. You have more abundance. And so things cost less. It's when you have a weak economy, a moribund economy, when you're not productive, when the goods that you need are scarce, right? That's when the price goes up. So rising prices are a sign of a country getting poorer. Falling prices are a sign of a country becoming more affluent. And obviously, they're trying to impoverish a lot of people in Europe. Now, in the very, very short run, right, prices can come down in a weak economy because of the effects of having to liquidate your inventory. Companies are squeezed. They have to cut their prices. So in the short run, right, you can have prices going down in a weak economy. But the ultimate effect is going to be the reverse, because once you liquidate your inventory, it's gone. You're not going to replenish it. So you can have a temporary reduction in prices followed by a surge in prices. And that might be what is transpiring in the Eurozone, that you had a relative benign CPI because of the, maybe the sales that were going on, the slowness in the economy caused businesses to have to wind down their inventories. But they're not going to be rebuilding those inventories to anywhere near prior levels. There's going to be a lot less stuff available for sale, and therefore the prices are going to go up. And I think that people are going to be surprised by how much prices go up. I mean, if gold is any example, if gold is up 20% in Europe in just 30 days, what other prices are going up? I mean, gold is just one example of rising prices in the Eurozone. Right? Now, everybody's got a reprieve because oil prices have come down, and they're still down. They're $46.50 or so an ounce. But who knows? I mean, obviously, oil prices can spike at any minute. Who knows, how long they're going to stay here. Meanwhile, if oil prices go back up to anywhere near where they were in dollars, well, then they're skyrocketing to new highs in terms of euros. So I think this plan is going to backfire. And maybe QE will finally be completely discredited because they're going to get inflation, but they're not going to get economic growth. Now, the question is, what about the United States? Well, again, all of this should make it more and more obvious that we are not going to raise interest rates. And in fact, we're going to do QE of our own. We continue to get more bad economic news. In fact, if you look at the unemployment numbers, the weekly unemployment numbers that came out this morning, jobless claims, again, above 300,000. We came in at 307,000, not quite as high as the upwardly revised 317,000 from last month, but we still have back-to-back months of over 300,000. In fact, the moving average, the 4-week moving average, is now 306.5 thousand. And they revised last month's moving average up to 300,000 as well from 298. We are the highest. This is the highest the 4-week moving average has been since July. This is a big deal. I mean, nobody is talking about this change in trend, but more and more companies are laying people off. More and more people are filing claims for unemployment. And I think that is a new trend that is going to accelerate as the year goes on. And I think it's going to show up in subsequent GDP numbers and non-farm payroll numbers. And the Fed hasn't even started to hike rates. Meanwhile, the dollar has caught this huge bid. We've had this huge run on the dollar. I mean, maybe this is all part of their plan, is that if they let the dollar run up high enough and then they announce QE4 and the dollar collapses, it's collapsing from such a high level that they're a lot further away from a dollar crisis, from a currency crisis. But I still think that we're not going to sit on the sidelines in this currency war, that we're going to come in, with all of our guns ablazing, and that ultimately it's the United States that's going to win the war. But right now, everybody is focusing on QE in Europe, rate cuts in Canada, and the strength of the dollar is pretty much spilling over into all currencies, and it's also spilling over into U.S. financial markets as people are buying U.S. stocks and U.S. bonds as a way, to get out of their own currencies and get into assets that are rising. But if you're in Europe, right, instead of buying European stocks, why not buy U.S. stocks? That's what people are thinking, because our stock market is going up so much more than the European markets when you take into account the currency effect. And of course, that's how people are going to look at it. So that's another reason why they're not going to get the same benefit. They're not going to get the same amount of euphoria off of their QE that we got off of ours. But again, that's all it is. I mean, we've got a stimulus high right now. We've been so high on this stuff for so many years, we think the economy is recovering, but the high is already wearing off. And of course, when U.S. companies start reporting their earnings, I mean, half the earnings are coming from overseas, so all these earnings are going to miss right away when they start reporting. So unless the stock market's going to just keep going up to higher multiples, right, it has to adjust to the weaker earnings. So there's going to be a lot of pressure on the Fed now not to hike rates at first and then to do QE later, because they'll be able to say, why? There's no need, right? The dollar's so strong. Why raise rates? And of course, if the economy takes a turn, if the unemployment numbers start to turn up, right, then they've got all the cover they need. In fact, it looks to me, that this media campaign where, you got this guy, John Hilsenrath, and writing these articles about, the Fed is so tight. They're going to raise rates. They're on this path. They're certain to do it. The Fed probably knows they're not going to do it, but it's trying to make them look more hawkish, like they really were going to raise rates. And then, they decided not to, begrudgingly based on the circumstances, even though their intention is probably not to raise them at all. They still want to maintain this pretense, right, that they can raise rates when they can't do it. They can't prick the biggest bubble they've ever blown. I mean, look at how bad it was when the last bubble blew up. Look how bad the financial crisis was. And this bubble is gigantic compared to that bubble, which was also huge. So if we got into so much trouble when the last bubble burst, there's no way the Fed wants to find out how much trouble they're going to be in when this bubble bursts. Unfortunately, there's no way to prevent it. They can postpone it, which is what they will do. But eventually we're going to find out. But again, if the bubble doesn't burst, it's because the dollar bubble burst first, right? Because they print so much money, they do so much QE, because they're so afraid of this bubble bursting that they end up collapsing the dollar. And if you think the euro is falling fast, or you think the Canadian dollar is falling fast right now, wait till you see how fast the dollar is going to fall. Because I think the dollar is going to collapse much faster than it rises. And again, as I mentioned last, that's going to put a lot of pressure on countries like China that are maintaining dollar pegs, right? I think they're going to pull a Switzerland because they're not going to want to go down with our ship. They're going to want to sever the ties. And that's probably also why gold is rising. I mean, think about this. Gold is going up almost every day, even as the dollar is going up. And it's very rare to see gold this strong and the dollar rising, which means, again, gold is extra strong in terms of every other currency. And in fact, I believe that gold is going to make a new all-time record high this year, 2015, in just about every major currency. It's very close to a record high against the yen. That could be the first one. But I think it'll make a record high against the Canadian, against the Aussie. I think it'll make a record high against the euro. It probably won't make a record high against the dollar. We might have to wait till 2016 before the price of gold makes a record high in dollars. But you never know. You never know. I mean, it could surprise me. Maybe we could do it this year, but it's most likely that we won't. But in terms of these other currencies, I think it looks like we will.
Today's financial advisors behave like pro wrestling TV commentators. They scream that the recovery is strong, debt is manageable, inflation is low, and that the Federal Reserve has everything under control. They may be oblivious, but the danger is real. Looking beyond the media hype can open a world of broader investing ideas. Euro Pacific Capital is a registered investment advisor that offers stock-focused wealth management services that closely follow the strategy of our founder and CEO, Peter Schiff. We concentrate on those countries that are more closely in tune with Peter's vision of how capitalism is supposed to work. And these investments are not hard to find, provided you know where to look. Isn't it time you change the channel and let Euro Pacific put a little reality back into your portfolio? If you live in the United States and have $25,000 or more to invest, call 800-727-7922. That's 800-727-7922. Non-U.S. residents access similar strategies through Euro Pacific Bank at europacbank.com. Euro Pacific Capital and Euro Pacific Bank are affiliated companies.